Well, good afternoon. Another month is behind us. July is gone and we're into August. This is my monthly update and I hope this finds you well. Well, this month I'd like to chat to you briefly in terms of what's been going on in the business, but also to focus on what's been going on in markets and the impact of low interest rates, what that means for decisions around allocating assets or investing in assets in your portfolio. Well, firstly, in terms of business update, I'd like to thank those of you who had some kind words to share after my last monthly update announcing 5 years in business. But I think from the feedback, more importantly, the fact that I've now moved to my own financial services license. I have spent the last month bedding that down, and I'm pleased to say most of the hard yakka is behind me. I do have to thank my compliance consultant, Jeannie, who's been there supporting me and will continue to do so going forward now that I'm a responsible manager supervising myself. So it's important to have her as part of the team. But more importantly, it's great to get the feedback from everyone that you think it's an important move to get my own license. I'm certainly really excited about it, and I think it will bode well for the future, particularly in terms of all the change going on in the industry that I'm working in. But enough about me, more about what's going on in the world and how that impacts your portfolio. Well, there's been a real shift in terms of central bank policy, and we've seen the Reserve Bank in Australia cut interest rates twice, and the Federal Reserve just this week made its first cut to interest rates since emergency measures were put in at the time of the GFC. Things like this are happening all around the world. Interest rates are dropping again. And that has real ramifications in terms of what investors do. Now, to give you an example, the Australian 10-year bond rate last night dropped to 1.08%. Now, just think about that. Would you put your money in an investment for 10 years and get 1.08%? Now, it sounds absolutely crazy, but that is where the world is going. And not surprisingly, that is causing investors around the world to think about other assets and taking on more risk to get their returns. It's a real dilemma. Now, to give you an example as well, the bond yield rate in Australia is almost half of that in the US. So in the US, it's over 2%. In Australia, it's around 1%. So that's also going to have an impact on our Aussie dollar. And it's not surprising to see our Aussie dollar at 68 cents. And mind you, the Reserve Bank likes that because it helps stimulate our economy. So reserve banks around the world are cutting interest rates primarily because they're concerned about global growth. So they're bringing stimulus back into markets and the economy. Effectively, they're handing the punch bowl back to the markets. And not surprisingly, the Australian market has touched its 12-year highs since the GFC. It's been great headlines for the newspapers, but not to take anything away from that, if you actually take dividends with the ASX 200, it actually reached its all-time highs back in 2013. But nevertheless, when you see that number reported on the news at night, to see it back to the levels of 2007 is certainly something to talk about, but is certainly an example of what the money is doing because of low interest rates. Now, I think at these levels, the market has its risks, and I think the market is due for a correction. But fundamentally, it does require a rethink in terms of, well, what do we do in terms of investment decisions? So in terms of portfolios, for a long time, I've certainly been investing in unlisted US property. And this month in the newsletter, there is a spotlight, fund in focus, on our investments in multifamily property in the US that were made back in 2016, which have got the tailwinds now of a lower currency, a strong US economy, and really great returns for investors. Now, I think in terms of the unlisted property market, that is certainly an active decision I'm making in terms of asset allocation in portfolios. Many of you will have seen the Charter Hall Industrial Property Fund. I'm also looking at a specific standalone asset in the office space as well. So keep an eye out for that. But looking for returns outside the equity market, property, or specifically commercial property, is certainly a good area to look at, where you can still get some attractive yields compared to where interest rates are. Now, the flip side of that for a lot of people out there is the mortgage rates are dropping, and we're certainly seeing some really low interest rates on mortgages, which is great. It's great for investors who have borrowed to invest, and it's great for the economy generally to ensure that the high level of debt is not costing the average consumer in the street as much. But anyway, so that's some things we're looking at. We've had a busy month in terms of capital raisings. The Centuria Industrial REIT, many of you will have seen that, raised some money this month. It's been a really good performing investment listed on the ASX, and also a smaller opportunity in terms of Callium Lakes, another good example of trying to find returns outside of the mainstream. And we're very excited about that project and the prospects for Callium in the next 12 to 18 months. Anyway, that's it from me for now. I hope this finds you well, and I look forward to chatting to you soon. Bye for now.